all of my viewers. Yes, today is a very special day for me. And yes, to make it very, very special, I have with me Vijay sir, none other than Sanik sir with me. And yes, we both will conduct this interview and will try to gather as many information from none other than we have our guest, and he himself is a Wikipedia. So we will try to take and to collect as many information. So without wasting a lot of time, let's start. Let's begin. Hello, sir. Hello, Sanik sir. Hello, Tom sir. How are you doing today?
Yeah, I'm fine.
Great.
Tom, good evening.
I'm doing great.
Good evening, folks. Thank you, Mukesh, for inviting me to interview Tom. And Tom, thank you very much for joining us. This is your first interview with an Indian channel, and we are as proud as anyone can be. Now, a little bit about Tom. As I was just joking with him, he's just not any Tom, Dick, and Harry. He's the Tom. Tom is one of the new market wizards featured in the bestseller of Jack Schwager, where he rubbed shoulders with other legendary investors / traders like Vic Sperandeo, Druckenmiller, William Eckhart, and Gil Blake. We are very familiar with Druckenmiller here, who was understudy to Soros, and Vic Sperandeo is also very famous, who's known as a Trader Vic, Trader Tom and Trader Vic. They are legends among themselves. To come into Jack Schwazer's bestsellers is something of an achievement, and Tom did it when he was less than 50 years old. This came in 1995. So we are doubly honored to be here, Tom, and try to pick your brain over the next few minutes. Tom, could you kindly tell us what's your background and how did you get into trading?
Well, I started out as a chemical engineer out of Clarkson University up in northern New York in the States. And what I found happening in the chemical engineering field, I enjoyed it, but it's a very industrialized business. And when you go through booms and recessions, especially the recessions, engineers tend to get laid off and they don't have jobs anymore. So I started saving money for sort of the rainy day, the proverbial rainy day that might come in the future. And I decided when it piled up to enough money, I needed to do something with it. So some of the guys at lunch that I would have lunch with every day liked the stock market and liked to talk about investments. And one thing led to another. And I started reading books, reading newsletters, fooling around with charts of prices, and I started managing my own portfolio. This was in the mid 70s, and I was very successful. I caught a nice bull market, made a bunch of money. Then I realized I wanted to have something that would allow me to make money when the market went down, which, I'm not a buy and hold guy. I want to be trying to do something all the time. It's my mentality. It's my sort of psyche. So what I ended up doing was experimenting with futures in the United States. Started out small, ended up taking 4 years to get to where I could make it through a whole year and produce a small profit. So 3 years of losses. Each year I got better and better at what I was doing, less losses, finally break even, made a little money. And then beyond that, it just got better and better. And now I had stock market portfolio going well, my futures portfolio going well. That was sort of the start of the being an all-weather trader that I've become over the years, and realizing that I can run multiple strategies at the same time. You don't have to just focus on one thing. And some friends and I got together and did a registered investment advisory in the United States. I sold my share of that and did TrendStat Capital Management, which I ran for 28 years. At the peak, we managed $600 million in currencies, futures, I traded about 80 different futures markets. I traded all sorts of mutual funds, stocks. There was a time when I actually did some bond trades. There were, and then certainly the exchange traded funds came in after that, which is what I use today instead of mutual funds. So it's been an evolution from engineering to sort of a stock manager to then more of a stock manager and commodity trading advisor to then probably most people knew me as a currency trader when I finished my career back in 2003. So I've been retired some 19 years now, and I put a smile on my face when I retired, and it hasn't gone away yet.
Great. We can see, we can feel it. We can feel it.
Yes.
So basically what you're saying is you and the market had got great chemistry.
Yeah, you could say that.
How you involved into trading? So what motivated you to come into stock market?
I came in by way of the stock market. And then what I would do is I would work every evening when I was done with being a chemical engineer. I would spend probably about an hour to an hour and a half every night updating all my charts, making my decisions, getting the orders in, and then I'd go back and work as a chemical engineer every day. So I kind of had two jobs for a while.
Tom, I told you, you must be prepared for everything in this interview. So I'm going to throw you a curveball here and ask you a quiz question. Do you know what is the similarity between you and Mr. Warren Buffett? You have something very similar.
Well, first of all, we're both old. He's older than I am, though.
I know.
I just turned 70, and
yeah. He's 91.
Yeah, he's a little older. The other thing is, in my mind, something that people do not realize is that everybody is a trader. Even Warren Buffett buys and he sells. He just does it over a longer period of time. So to me, that's something we both have in common. I may trade, a futures contract, and I might be in and out of it in 4 days if it's a loss, and maybe I hold on to it for a couple months if it's a gainer. Warren will hold it for longer time periods. But the fact is, you still have to buy, you still have to sell. And a lot of what you have to do with respect to your position size, he can't put all of Berkshire Hathaway into one position. That would not be capable. He would not be able to do it. So there's position sizing that goes on. There's his methodology. I have a methodology. He has a methodology. We both have a strategy that we're employing. And I think that that's what you see common in a lot of traders, a lot of the market wizards in the books. They have one thing they do, and they do it well. And they understand it, and they know the good and the bad, and they have the mental process to deal with it. I think that's what's common amongst everybody that's been successful in the business.
I will tell you something which you probably missed out. A very interesting trivia. Both of you started your careers at age 12. You went and bought your first mutual fund as a delivery boy, paper boy. Similarly, Warren Buffett also did that at age 12. He also used to deliver magazines and newspapers. So both of you are very similar in that way. 12-year-old, when we are all not knowing what life is, you were cycling your way, and not only that, you're earning money by doing your work. That I think is a huge achievement in that sense. You started very early.
And then I started taking the money that I earned from that and buying mutual fund.
Oh, that's good.
I know.
So I actually started investing when I was 12. That's a long time ago.
Yeah, I know. That's why I said you're 60 years old in trading, and I'm just 60 years old physically. And you're not retired. You may be tired, Tom, but you're not retired. A trader never retires.
Yeah, I have a lot of friends that look at my life and say, "You're not retired." But I say, I could choose to do this interview that we're doing, or I could choose to not do it.
Yes, that's true.
I'm having fun.
Absolutely.
I get to do whatever I want to do every day. If I want to go play golf after this interview is over, I could do it. It turns out I've got some other clerical things I want to work on that are
Yes. You have earned it, Tom. You have earned it.
but
You earned it.
I
Okay,
don't have,
what may not be so much of a fun is when you handle somebody's account and it blows up. Typically, they say that if you are not blown one account at least in every decade, then you're not a good trader. Is that true? What do you think about it?
I would call losses in general, whether it be blowing up or whether it's just a good hit, like you just take a 30% hit on something. I would call that all the tuition at the College of Trading. If you learn something from that loss and you figure out a better way to do it to avoid that loss in the future and understand where it came from, whether it was you being dumb and overriding your strategy, whether it be not doing your homework on the company that you bought, whether it be not looking at your charts, but just hearing a hot tip from somebody and reacting inappropriately to it. Whatever that reason is that you took those losses, whether it be a wipeout of the account or whether it be just a serious loss, I think you can learn from those a lot. And I certainly have over the years, and I've gotten better and better, and I'm still learning, even at 70. And I think that's the way I would answer that. I don't really think you have to. I can't remember whether I ever closed. I don't think I ever closed an account down as completely wiped out. I don't think I ever did that. I came close. I really got seriously damaged multiple times, actually. But I learned from each one of those. That's why I have more volatility control these days. That's why I manage my risk better. I position size based on risk and volatility. All those tricks that I learned came out of me taking severe losses.
Great, good to hear that. So, Tom, is there any holy grail method in trading?
Oh, no, I don't have one formula. I trade 8 strategies every day. And if I'm sitting here at the desk, a 9th strategy that operates on a 5-minute bar, that's a day trading type of thing that I do with stock indexes. What I try to do, I think of the markets out there, whether it be the commodity markets, futures markets, currencies, stocks, they're all prices going up and down. I don't try to get emotional about any of them. I don't try to limit myself. Crypto is another one that more recently has come in. All of these markets move up, they move down, they go sideways. So my job as a trader is to try to figure out how I can exploit various return streams out of those. And sometimes it's the up market return stream. Sometimes if I'm hedging, it's the down market return stream. Sometimes if it's futures, I'm going for extreme diversification and I'm looking at trying to pick up an intermediate term price movement kind of. So when you look at the different return streams, each of the strategies, the 8 that I trade every day and the 9th that I do intraday, they all have a very specific goal and purpose in life. They're not trying to do everything. They are trying to extract certain type of benefit that the market will provide in certain conditions. And the rest of the time, when their job is not queued up and ready to go, they're trying to stay out of trouble. An example would be if you have a hedge strategy. A hedge strategy would go on if you got a long stock portfolio and you want to put a hedge in. I've got this making money with my palm this way, and I got the hedge going that way. So if the market goes down, I'm okay. If it goes up, I'm okay. And what you're really trying to do with that hedge strategy is to protect yourself during a down move. Now, during an up move, what would you want to do? Well, you want to take the hedge away and let the stock portfolio go up. So the hedge strategy is designed to try to protect me from catastrophic failure. At the same time, it's also designed to try to just get out of the market when it's going up because I don't need to be hedged. So that's kind of the common theme amongst all the strategies. They have a purpose. And I think too many people are searching for the magic answer, and it's got to be a global, always make money in all conditions, up, down, sideways. I have never found that. If somebody has, they're better than me. And
nobody has found it.
I think it's a lot easier to slice and dice the markets into different purposes and try to design strategies to exploit what you see is available out there.
Okay.
When you said you're doing 8 to 9 strategies, these strategies are what, across different asset classes, or is it on time, or is it on price, or what is it based on?
All of them. First of all, I trade 26 different futures markets using a more of an intermediate term trend following approach. Then I would, let's see if I can remember all these. I trade crypto futures by a very short term trend following approach. I trade a NASDAQ stock index futures with up and down direction with a very short term trend following approach. I trade a 26 futures markets using a very short term overbought, oversold counter trend type of approach. Then let's see, I also trade 20 different sector ETFs or exchange traded funds, and I trade those long only, and I trade those with a what I would call a long-term trend following approach. I trade some options. I do credit spreads on stock indices out of the money, and that's to pick up money during sideways periods, because it's very, very effective to sell credit spreads when the market's not going anywhere. And so I look for an overbought condition, and I sell a credit spread on calls, or I'll look for an oversold condition, sell a credit spread on puts. So you can see that each of these that I'm describing clearly has would have success in different types of conditions. Some short term, some long term, some intermediate term, some in futures, some in stocks. Okay. By doing all that, what happens when you add it all together, you become sort of all weather. You really, I almost don't care whether the stock market's going up, down, sideways. That's why I can be Mr. Serenity. Is
absolutely.
One day,
but do you allocate the same amount of capital to all your strategies, or you have different buckets of money put in each of the strategies?
That's what I try to do. Is I base the leverage of each specific strategy on the total equity of the whole portfolio.
Okay.
So even though I know that it's only having a small effect, like if I'm trading crypto futures, there's only 2 crypto futures. Yes. You can only do so much with that. But I have those dialed in so that they have a similar effect as what I might get from one of my sector ETFs that I'm trading. So on a good day, the Bitcoin futures might move just the same way as an energy exchange traded fund might move. So I try to get the volatility measurements to balance out a little bit, so that when I've got right now probably 60 positions in my portfolio across all sorts of places and different time periods and everything else, each one of those can contribute to the success or the harm to the portfolio. And when I get the edges right in each of those instruments, on balance, if I look at my screen on any day, clearly I'm going to have green and I'm going to have red. There's no way. If I see all green on the screen, it almost scares me, because that means the whole world is lockstepping together for some reason, and I'm on the right side of all of it. And when it turns the other way, it's going to be all red.
All red. Yeah.
And so I don't mind seeing, as long as I see more green than red, then I've had another good day, and we just keep going on. That's a very typical day. It's very rare for me to look up at the screen and see, oh my gosh, the whole thing is red or green. That would be a rare day.
Yeah. Leading on to the previous question was about leverage. See, when we talked of blowing up our accounts, the most important reason is leverage more than anything else. Right from LTCM, for instance, the smartest guys on the planet blew up their account because of insane leverage.
If you look at
what is your thinking on that?
If you look at the Market Wizards, both books, and then of course he's gotten into Stock Market Wizards and Hedge Fund Wizards, and it's a franchise for Jack. He does a great job with those books. I love them. But if you look at some of those guys in there, they're no longer around.
Yes,
they blew up. And the reason they blew up was too much leverage usually.
Absolutely.
And I would say that the questions I get from people all around the world that send me an email or they direct message me on Twitter or whatever, they tell me what they're trying to do, and I try to help them. The vast majority are undercapitalized. They are way too leveraged. They're rolling the dice, so to speak, because they're either going to hit it and have a big account and then they can sort of notch it back and be more sensible, or they're going to wipe themselves out. And a lot of them wipe themselves out. And it's always the leverage. Now, when I was in the business as a CTA, we would run about 15 or 17% margin to equity. So the leverage there to the face value of the commodity that I'd be trading is somewhere, between 5 to 7 times, say 6, something like that. That is a fairly common level for professional commodity trading advisors to run back in the day when I was doing that business 19 years ago. Where they are today, I have no clue. Probably less, I would guess, in general. What I run right now in my own portfolio is right about at that same level, about 5 to 6 to 1. Now, when you get into stocks, if you're just a stock trader and you're just going to have a stock portfolio and you're not going to get into any diversification, what you find has happened around the world. When New York has a bad day, Hong Kong has a bad day, the Nikkei has a bad day, India has a bad day. Over into Europe, we have the German market, the UK market. They all have bad days, and then we're back to New York, started all over again. Everybody is doing the same thing. Computers can route orders so quickly and easily around the world compared to what it was, 50, 60 years ago when I was getting started. So international diversification isn't what it used to be. And when you're in a stock portfolio, because of the indexing, especially in the United States, it's very pervasive. I'm not sure what it does in India, but if you look at the S&P 500, probably the top 20 names there are going to drive the S&P 500. The Dow is only 30 stocks.
Yes.
It's not that much diversification. So if one of those is having a good day and the next one's having a good day, and all of a sudden the Dow Jones is up 100, chances are it's going to bring the entire market, all the stocks are going to tag along for the ride. There's a very high correlation. So I would suggest that your leverage there has to be less than what I can do with futures because it has less diversification. Everything's correlated.
Great.
That's good. That's good.
What does success mean to you in trading?
Well, success to me, I would say, is understanding what you're doing well enough to where you can execute it flawlessly every day, that you've dealt with up, down, and sideways markets, that you know how you position size and you know that it's appropriate for your situation, and that you can get done with your day and go out and golf and go out and cook a nice meal or go out with friends and not have it keep you from sleeping at night. That's, to me,
a good night's sleep. A good night's sleep, I suppose.
Good night's sleep. You've met your objectives.
Yeah.
You've executed it flawlessly. You understand why you do what you do every day. And there's no real worry or question. And you're basically Mr. Serenity. You're just cruising along, enjoying life. That's
wonderful. Good to hear that. So,
Yeah,
like,
it is said that market is like a golf course. Different markets, different golf courses. Sometimes you get a birdie, sometimes you get an eagle. So you see, you end up making a mistake, and sometimes you aim for something and it below par, or sorry, above par. You go above par because your strokes are not good enough, even though you've been playing the game for decades. I'm sure that happens to you in the markets.
It sure
So
does.
how do you correct them?
Well, usually my goal for correcting a mistake is usually what happens. I have a few things that I have to do manually. I just haven't automated them yet, or they don't lend themselves to automation. And so when I make a mistake and I see, oh my gosh, I have 3 short British pounds. I'm supposed to have 5. I'm looking at my spreadsheets. I'm going, how did that happen? And I go and I try to figure it out. I try to learn from the mistake. First of all, how did I make that mistake so I can try not to make it again? And then I immediately at market reverse the position or whatever I have to do to get back on the program immediately. And that's just a good practice. And sometimes I had an error yesterday that was a very nice profit. I just lucked into it, but it was an error. So I don't sit there and play with the profit. I just market order out of it. I'm now back on the program. I'm doing so many things that you can imagine. If you're trying to do 8 strategies and you realize that they're all very well thought out, very well position sized, everything has been, I've spent a lot of time putting those little pieces of the puzzle together. It doesn't make sense to me that when you make a mistake and you get off of that myriad of strategies, that you would then try to use your discretion with that error and try to figure out how to trade your way out of it. I just market order out, boom, get back on the program.
Nice.
Great.
Good to hear.
So, continue with the previous question. What is more important for you, the psychology, the portion sizing, or the risk management?
Okay, I would definitely start with the least important is in trading is what everybody concentrates on, which is the buy sell engine. I call it an engine because engines move you. They move the car, they move the truck. A buy sell engine motivates the trader to buy or sell. And that's what everybody spends. They think there's some kind of magic formula that will give them the buy sell indicators that'll always be right or whatever. They keep searching for it. And that is the least important, I think, in successful trading. Next up on the priority would be risk management. And the risk management is, I think, an area where, again, we talked about leverage. We talked about being able to come back and play the game again tomorrow. You don't want to wipe yourself out because then you're done. So that's next most important. You have to manage your risk. And the easy way to do that is by the next item, which is position sizing. Position sizing, to me, you can, if you think of it in terms of what Larry Hite, who was one of the original market wizards and inspired me in some ways on my risk and volatility controls, he made a statement that if you think of the game that you're playing, you want to make sure your bet size is the same on every position so that they all can equal each other. They all can contribute. They all can hurt, but you've got it under control. All you have to do is get one of your positions too large or others too small. The large ones will drive your portfolio, good or bad. The small ones will not contribute. So you might as well not even have them. So you've got to get everything sized correctly. And studies that I've done back in my TrendStat days showed that position sizing is more important than the actual buy-sell decision, because what ends up happening is you could randomize, flip a coin and get into a position. And if you trade 20 different futures markets and you get crude oil going from 50 to 100, guess what? That's going to drive your profits for that period of time. And if you've properly sized it, not too much, not too little, it will drive your portfolio, and everybody else will stay out of the way and, make money, lose money. But there were some times when just one or two trades in an entire year would drive my profits for the year as a professional trader. When you realize that position sizing is critical, because if you get off of that, that one position can't drive your profit for the year. The last and the most important of all, and most traders ignore it, they don't even think of it, is your own mentality. If you're not aware of what you're doing, if you're not through awareness, disciplined, if you don't have the self-confidence to take a loss when the market hands you a loss, and take it in the spirit that it's meant and learn from it and get better at it, you are going to find a way to mess it up. Yeah, I don't care if you spend the next 10 years simulating the best possible strategy you could ever simulate, and it's got numbers that would blow your mind. If you can't execute it and have the mental side to deal with the ups and downs and the goods and the bads and the backup plans and contingency plans to deal with internet outages and electric outages and all the other things that go into keeping everything going smoothly, you will screw it up. And then what do you got? You're still trading, but you messed up your well thought out plan, and it's all for naught. It doesn't mean anything.
True, very true. So
you are not a fan of algorithmic trading.
All right, here's what I would say about algorithmic trading, and I can't wait for the emails I'll get from algo traders. Algo traders have to program sooner or later some code. The human being that's designing that code, and I've done a lot of algo trading. If you want to think of it, I mean, a lot of my stuff is formalized. And some of it actually sends the orders in. Some of it, I have to put the orders in myself. But that's algo trading. But all of my algos are based on my biases, my mentality, my risk levels, the markets that I want to choose to go after and avoid other ones that I think are not viable markets. And when you think about that, then the algo trader is just taking computers and extending his own psyche into the computer, and then the computer is doing the drudgery, the dirty work of the execution or the whatever it is that the particular strategy goes after. And algo traders can be anything from picking up this much in between the bid-ask spread, or you can create an algo trader that would stay in a position 200 days. It's all a matter of how you program it. And so I don't think of algo traders as anything other than a more efficient way of extending the human brain and the creativity and how to trade to the actual marketplace, and getting away from what happened when I started out in the business, and I'd have to call my commodity broker. The commodity broker would have to take a piece of paper down to a teletype. The teletype would have to go transmit it to New York. In New York, a runner would take it out to the pit. The pit guy would then do this with his hands and all that, execute the trade, drop it down on the floor. The runner would pick it up, take it back to the side of the pit. The teletype operator would send it back to St. Louis back in those days, where I was. And then my commodity broker would call me a half an hour later and say, you just got the fill. Nowadays, you go on the computer and you hit a button, and by the time you hit it, it's the confirmation's already down in the corner of your screen.
Absolutely.
It's just the efficiency of computers doing what human beings had to do in the old days. I don't view algo trading as anything particularly exceptional.
Okay.
Very true. Tom, what else do you do for, apart from trading? I heard in one of YouTube, like you gave interview, you do dancing, you do singing, golf, a lot of things you do. Am I right?
I do. One of the beautiful things about trading in my mind is it allows me the flexibility in retirement to make every day different. spent 10 days taking a road trip to Utah and Wyoming. I was in Jackson Hole a week before the Federal Reserve was meeting there this week, I guess. And I hiked some beautiful mountains and lakes, and we went fly fishing twice. And I had a lot of just great meals, and took a gondola all the way up to the top of Teton Village and had lunch overlooking this magnificent scenery. And then even when I was driving, when you're driving for a long period of time, say an hour and a half, 2 hours, my wife is sitting over in her seat and she's maybe on her iPad, or maybe she's just taking a nap. And I get to drive along and think of things and just sort of be inspired by the beauty around me, and think about my life, think about trading, think about whatever. And it's amazing how getting away from it all can inspire you, or create some good ideas that you can't wait to get back and try these out, because they sound in your brain, they kind of come out pretty well. And so I enjoy doing stuff like that. But singing, I'm a bass voice, and I sing in a couple different choral groups.
That's very interesting.
I met my wife dancing, actually.
Oh, very interesting.
And dance lessons, actually. And then let's see. I love to cook. Last night I made a zucchini, which would be a squash. And I hollowed out all the seeds, and I boiled it so that it would soften it a little bit. And then I stuffed it with a mixture of Italian sausage, mozzarella cheese, some herbs, some pine nuts that were toasted, and some chopped mushrooms that had been sauteed. And then I put some Parmesan cheese over the top of it, and I baked it for half an hour. And that's what we had for dinner.
I can see you are enjoying your life.
Yeah.
Wonderful. So do you have any plans to visit India anytime in future?
Well, the short answer is no. The long answer is I traveled the world all my life. I had clients, I'd go to Hong Kong, I'd be in Japan, did a book tour in Japan. I've been to London, I don't know how many times, Geneva for various conferences. And so the longer answer is, I hate getting on a plane. I really love it. So it's not anything against India, believe me. If you could just hit a button and somehow transport me from Payson, Arizona, where I am right now, right into Mumbai or whatever, happy to do that. I just hate airports. I hate the security. I hate all the COVID tests. I hate I'm 6'3" tall. I don't know what that is in meters, but
1.8 meters. Tom, I think you should come in your private jet. Why are you coming by commercial?
No, that is not. Even a private jet would have to refuel about twice or three times, depending on what you got. And I don't want to have a private jet. That would mean I'd have to travel. And I don't really want to.
Global warming.
I have everything I need right here. Why would I want to leave?
So true. So let's continue. So Tom, the next question is, do you believe in indicators? Nowadays, we have a lot of indicators. So you basically trade based on indicators or only with price action?
All right. Well, to me, what you're talking about with price action, first of all, let's think about this. Price action is the only single thing that will affect the profit and loss statement of your portfolio. Everything else doesn't make any difference what interest rates of the central bank is doing, doesn't make any difference what India's economy is doing, or the United States economy, or whatever. That's a secondary thing. If those things happen to feed into various traders' psyche and they decide to buy or sell, prices move. Price is what ends up affecting your portfolio. That being said, if you're just looking at price and randomly trying to decide what to do with it, you're going to be looking at a lot of noise. It's all the time going up a tick, down a tick, up two, down two. It's all over the place. If you watch something tick by tick all day long, it drives you nuts. It's just, you're looking at noise. So indicators, especially those that have a price component to them, are nothing more, this is engineering talking, it's nothing more than a dampening of the instrument that you're measuring something with. So if I'm in a chemical engineering sense trying to measure a chemical going through a pipe, and I've got a heater that's going to heat it up if it gets too cool. Well, I've got a temperature measurement in there, and it's going to send me lots of information every 10 seconds, 15 seconds, 1 minute, whatever. As the outside temperature gets colder, this stream of chemicals might get cooler and cooler. I have to turn on the steam, open the valve, get the steam to go and heat up that stream to get it to the right temperature that I need it. So kind of the same thing as the market. There's lots and lots of price information that's going all over the place. What I want to do is use an indicator to try to dampen all that noise down into meaningful information. And I only want to take action when that price action drives my indicator to a certain level that triggers that trade. So I view indicators and price as just a cousin of each other. They're brothers. One is the actual raw unit it's the baby running all over the place and doesn't know what they're doing. And the indicator is sort of like the older brother that has common sense enough to realize that the baby is just randomly doing stuff that doesn't mean anything. And he's actually trying to do meaningful things with his actions. And kind of the same thing. They're both actions, but in one case, it's just random. In the other case, you kind of have a little bit more purpose to it.
Yeah. We call price is God here. In Hindi, we call it Bhav Bhagwan. That is, price is God. And indicators, if I may call it, you explained indicators beautifully like a good chemical engineer would do. And I would say indicators like the shadow so you look at the shadow and you'll know what time it is, what time of the day it is. So in some way, an indicator will tell you much more than just looking at that person. His shadow will tell you what time of the day it is based on the length of the shadow for that matter. So I would like to look at it like that. Well, very interesting.
I prefer price-based indicators. So I like indicators. And I lean towards ones which have a component of adjustability built into them. So I will give you an example, several examples if you'd like. Donchian channels, which was invented by Richard Donchian before I was in the business. He's long ago passed away. He said, why don't you just look back for X amount of periods, 20 days, 30 days, whatever you'd like. If you're a long-term trader, maybe 50 days. If you're a shorter-term trader, maybe 9 days. Look back and say, what was the highest high over that whole period? What was the lowest low? Draw 2 lines across the page. If it ever breaks the top line, buy it. If it ever breaks the bottom line, sell it. Yeah. Very simple. So what has he done there? He's created a dampening because he said everything that's inside these 2 lines, high and low, is noise. We'll ignore it. If it goes above the line, we'll take action. That's information. If it goes down below the line on the bottom side, that we're going to take action there too, because that's information. And then we're just going to ignore everything. And more importantly now, in addition, let's say the market's volatile. What's going to happen with these 2 lines? Farther apart.
Yes. Yeah.
What happens when the volatility goes down? What happens? 2 lines get closer together. Yeah. So it's automatically adjusting for volatility and market price movements by changing the width of those lines. So nothing is fixed. It's always adjusting itself. It's going to be more robust that way.
Yeah. Did you think of making your own proprietary indicator?
I do have my own indicators.
Well, you have.
I have created some, over the years.
Fantastic.
And they're frankly too complicated to explain.
I know. I can understand.
But another good example is a very famous one, Keltner bands. Keltner bands do nothing more than they create an exponential moving average. So there's your center of the noise. And then what do? They put a times factor based on volatility as measured by average true range above and below that moving average. So what do you got? You got your two lines again. And are they adjustable? Yes, because as the ATR or average true range gets bigger, what happens to the lines? Farther away. If ATR goes down, it gets bigger again. So you've got an adjustable trend following model that's based on price, nothing else. And volatility is measured in there and adjusts. So I find that those types of indicators are far more robust over long periods of time because you don't have to re-optimize them or worry about changing in the market. If it changes in the market, the indicator changes itself. Yeah,
we call it Keltner's channels. That is what we call it here. They're not very popular. Maybe I'll have a look into it. You are speaking of, because you're the first person I've heard speaking of Keltner's channels. I know it is there, but let me check it out tomorrow. That's one learning.
I've used them for decades.
Okay.
That's great.
Good to hear.
How important is the role of a mentor? If I am a newbie trader, if I am a new trader, so how important is the role of mentor in our life?
It can be useful and it sometimes could be harmful. Kind of depends on the mentor you select, huh?
I know.
If you look at like Trader Vic and myself, both of whom were in the same book, you would realize that the way we both trade couldn't be farther apart. And remember that back in the day when I started, there was no appreciable amount of internet. I mean, this was even before dial-up phone modems that did 2,000 bits per second. Not megabits, not gigabits, bits.
Bits, correct. Yeah.
They were so slow that pulling down data to run 20 different markets would take me 10, 15 minutes to pull down the data. It was insanely slow. So there was no internet, there was no browsers, there was no Twitter that I could direct message Tom Basso and ask him a question about, how do I size my positions? I don't understand it. And so what I tried to do is I tried to create in my mind my own version, not Trader Vic, not Gil Blake, not anybody else, me, my own perfect trader. Call him a super trader. He always makes good decisions. He follows his strategy every time. He makes zero errors. He is comfortable with everything he's doing. He's aware of everything that's happening around him. He's got perfect contingencies. If something happens, something else goes into plan B. That perfect trader became my role model for me to try to understand what am I doing and how do I get there? And I just tried to keep pushing myself in that direction.
Your alter ego. Is it your alter ego?
No, I don't know, maybe. It became me eventually. I kind of feel like I've arrived where my former super trader was back when, this has been the 1970s. I've probably pretty much achieved what I was trying to shoot for. But, I didn't have any role model. I didn't have, I got some things from Larry Height's chapter of Market Wizards, but I never communicated with him until this last year. We sent some emails back and forth to each other after I complimented him on an interview with Michael Covell. He and I chatted, and nice guy. I love, he's funny as heck. He's great. He's getting old like me.
You're not old.
We had a good time talking, and I find that a lot of the people who think of the mentor situation, they are trying to absorb and become exactly like that mentor. And I would offer a slightly different look at that. Each trader, the three of us on this screen, the Zoom screen here, each of us has different expertise, different time commitment capabilities. I mean, I want to go out and play golf or hit balls or go out in the garden or do some pruning, or I don't want to sit in front of a screen, but one of you guys might want to sit by a screen all day. All right, well, that's fine. I'm not saying that's bad. I'm just saying each of us has different skills, time capabilities. Each of us has different capital amounts. Each of the size of our accounts are different. It seems to me, in terms of mentors, if you're starting out small and you find a mentor that's trading multi-millions, I'm not sure how much that's going to relate back and forth. There's certain things that you can do with size that you can't do with small size. So I'm not a big mentor fan. I think everybody needs to come up with a way that they should trade. What is right for them? I don't think you need to copy me. I don't think you could copy me. If I took everything I'm doing and dumped it over 2-3 days to you, and then you looked at it all and you took great notes and all that, and you looked at it, I can't do that. It could either be legal requirements, maybe you can't trade futures in India, or maybe you can't trade US stocks or ETFs. The SPY, which is the most traded vehicle on the New York Stock Exchange, the Standard & Poor's 500 ETF, is illegal to be traded in Europe.
Oh, okay.
Okay.
I don't know why, but it is. And so there's just differences where people live, where the rules and regulations, the size of the capital, the skill levels. Some of us have computer skills. Some of us do not have computer skills. So you can all be successful in trading. You don't need computer skills to be a good trader. But if you have computer skills, it might lean you to design what you're doing using more automation. So I don't know about I wouldn't be heavily mentor oriented. I would be very careful trying to tie your wagon to one person or one style or one thing. I think you need to find your own.
I have a theory here. I have my own theory on time, time as a trader. You have been trading for a very long time. So I strongly believe that there are bold traders, bold traders, and there are old traders. There are bold traders, there are old traders, but I've not seen a bold old trader. So are you still a bold old trader or just an old trader?
I'm an older trader. I don't view what I do. I mean, I've got enough money to retire. What's going to change if I created 100% return like I happened to luck into in 2020 with 103% on my portfolio? That's insane. That's the best year I've ever had in my life. Did I try to go out and get 103? Hell no. The reason that happened is the markets went insane. And so my positions that were just my normal everyday positions I'm doing the same way right now, just ended up, COVID crashed first, and then I reversed the positions and made money on the way back too. So I made it on both sides of the COVID crash and the subsequent recovery, and that fed a lot of profits. The point I make is that the markets do what the markets do. I don't have a control over that. I go along for the ride, and I might as well enjoy the ride, which is why I called my website Enjoy the Ride. And when you're bold, you're trying to force it. You're trying to leverage it. You're trying to do things. What I'm trying to do is just extract whatever the markets will give me and not try to force it, not try to be leveraged. I want to sleep well at night. I want to be retired. I don't want to go back and manage money. I don't want to go get another job. Although a lot of people say that I seem to be an awfully busy retired guy. I enjoy what I do these days.
So maybe we should classify last year's performance that you are a gold trader,
Gold?
Because it's a golden year for you. It was a golden year.
that was probably multiples of my best year ever in my life. So it was pretty insane. But everything I did during 2020 was exactly the same as I'm doing right now. I'm not, I don't change it. I don't, like, oh, wow, the platinum markets or the palladium market's going crazy. I'm going to make a bunch of money there. And I don't do that. I just put one more trade on. If it happens to be palladium and palladium shoots up a whole bunch during COVID, all right, then I made a bunch of money. It's no extra effort, energy, stress, or anything. It's the same exact thing I do every day.
Yeah. What do you do? What do you do when you have a hot hand and when you have a cold hand? You see, traders do have hot hands, and they may last for a very short span of time. So it's generally believed when you have a hot hand, you make the most of that opportunity. Mm-hmm. Now, that's easier said than done. More importantly, what do you do when nothing works in your favor? When everything is right as far as you are concerned, but the market is not rewarding you.
Okay. All right. So market's not rewarding you would be a market going sideways, because traders need to buy low, sell high, or sell high, buy low in order to make a profit. If you're not making any profits, the market's not going anywhere. So I try to have strategies that'll do things over a very short period of time, trend following, or I'll do mean reversion type stuff like selling credit spreads in options. But I do that all the time. I don't do it just when the market's going sideways, because I don't know ahead of time whether the market's going to go sideways or not.
True.
So I'm running that strategy even when the markets are going nuts, and I'm losing on the strategy.
Yes.
But I'm making even more over on the other side.
Yes.
So in answer to your question, hot hand, cold hand, if you look back to the sort of the three pieces I talked about, your buy-sell engine, your position sizing, and your mentality.
Yes.
The hot hand means you kind of have a lot of green on your board.
Yes, correct. You alluded to that.
Good. And what happens with me is I don't do a single thing different. Why? Because my position sizing kicks in and says, whoa, Tom, you're green. Some of these positions are getting so far from your stops that the position size is too large for your preset parameters. Okay. So what I do is I take profits selectively, peel off positions, and get them back down into acceptable ranges for my psyche to keep me comfortable. So when I have a hot hand, I'm actually more likely peeling back into the hot hand. And when I have a cold hand, the equity is going down, the risk is getting less. Yes. New positions that are coming on are going to get larger because the volatility is down. My initial position size is going to be able to put on more position. Yes. And what happens in those drawdowns then is when it turns the other way and markets start moving again, those nice positions all of a sudden just go crazy. So I don't change a single thing I do, no matter whether I'm hot, cold, or whether the markets are moving or not moving, up, down. I do the same thing every day.
Yeah,
great.
This mentor question came about. I'm sure all of us are looking for the mentor simply because, you see, we have this nagging doubt when we enter the arena of trading. Am I fit for trading, or is trading fit for me? So somebody has to tell me whether I am fit. The one way of doing it is, trading and losing continuously, and then realizing that you are somehow not fit. But there could be another way of somebody telling you to fit yourself into trading. That is the reason why we think we require a mentor. How do we know we are unfit for trading or fit for trading?
I think from my standpoint is to think through all the aspects of what you need to do from start to finish. Create a plan.
Yeah.
And then execute the plan. As soon as you have the plan, if you then can execute it, you're fit to trade probably. And the aspects of a plan are far more complex than people give it credit to.
Okay.
Let's say you're looking at the stock universe. You got
Yes.
the Nifty 50 in India. There's 50 candidates right there that you could trade.
Yes.
You've got a lot of other stocks too, though, I presume. So you've got, in the United States, we probably have 3,000 fairly liquid stocks that you could trade. That's a universe that you can't buy all of them. You got to have a strategy to narrow that down to what you're going to look at. You got to have a strategy for what is the setup you're looking for. What is your indicator that you need to filter the final 70 stocks that you came up with down to 10 that you can actually buy? How are you going to trigger that buy and sell? How are you going to set your risk level on that trade? Then, based on how much risk you've taken on per contract or per share, how many of those shares are you going to buy? You got to answer that question too. How is this going to relate to the other positions already in your portfolio? And then you execute it. But your job's not done because the markets start moving around and give you profits, losses, whatever. They give you greater risk at times. They give you less risk at times. They give you more volatility, less volatility. What does your plan do during all of these various things that might happen? Adjust your position sizes if you have to. Move your stops when you can.
Okay.
All of that is part of the plan. Eventually, how are you going to get out of this position? Whether it be 2 years, 3 years, 5 years from now, how are you going to get out of the position? From start to finish, then you have how you screen the universe, how you narrowed it down, how you got into the position, how you managed the position, and how you got out of the position. Now you just got to do it. If you have all those things in place, and most people don't.
Yeah, that's true. That's true.
That's
If you
true.
if you don't have them in place, then you're not fit for trading. You haven't finished the job of designing your strategy.
Yeah.
Strategy is not where you buy and sell. There's the strategy encompasses the position sizing, how you're going to deal with the mental side of it, how you're going to deal with screening your universe down, how you're going to deal with diversifying your portfolio. There's so much more to having complete strategy than people give it credit for. And that's why a lot of people are not ready for trading when they first start trading. But they either learn by their lack of having those things in place and losing money, or get washed out and they quit altogether, or they're successful and they have figured out a lot of these things and they're prepared to take it on.
Yeah, this is a quote attributed to Linda Rashke, who is, I think, a famous market person. She says, plan your trade and trade your plan. That's, I think, she is like beautiful.
I like that.
Yeah, she's some. I have just two last questions. The first question is, what is, you have a very hectic life. After that, after trading, what do you do after trading hours? Now, though, you are absolutely free, so you're going to play golf during the day and you couldn't care less. But let's say when you're a trader.
Well, if I'm a trader and I've had a hectic day is not really something that happens very much to me because I do the same thing every day. So I might, a hectic day in your mind might be I either lost a lot of money or I made a lot of money or something like that might be what you're thinking is a hectic day.
Yeah.
But remember that no matter what kind of day it was, I still do the same thing. I get down to the end of the day and I run my about an hour worth of processes and I get all my orders positioned for the next 24 hours and I'm done. And what do I do after that? Like last night, I went and I worked out for an hour, did a bunch of cardio, about a half an hour of cardio, and I weight lifted and did some body exercises for about a half an hour with my wife. And then I came back and she went down to do some reading. She has to do some exams to stay certified in real estate. So she was doing that and I was cooking dinner, the zucchini I mentioned earlier.
Yeah, I know, you mentioned that. So I heard in your interview, in one of the interviews which you did, a podcast, that people from India contacted you and talked about momentum investing and momentum trading. Did you get something like that? Okay, even if it is not true, even if not, exactly right. See, there are traders. Typically, all of us want momentum in terms of trading. We trade instruments which have momentum. Now, it could just be possible that we identify an instrument where there is no momentum at this point of time, but we anticipate a momentum coming later. Do you look for such opportunities?
No. What you're doing by doing that is predicting.
Yeah.
So true.
Predicting carries with it both erratic statistics in terms of your reliability of the strategy. And it also carries with it a heavy psychological burden, because you have predicted, your psyche starts taking on this prediction as, I want this to be right. So when it's right, you credit yourself as being brilliant. And when you're wrong, you beat yourself up about being wrong.
True.
And so that's the problem. When I do anything in momentum, I'm always waiting for the momentum to already be occurring. And then I'm jumping on for the ride. I never anticipate anything, and I never predict anything. I don't, like an overbought, oversold condition that I use in my counter trend trading. I use a stochastic RSI to measure that. So it says, okay, I'm oversold now. I want to look to buy, but I don't buy. I wait until I get my short-term trend following trigger to go over. The buy stop gets hit, and I'm in. So I'm measuring the trend right that moment. The order gets executed. I am never anticipating it and buying it early.
Yeah, you believe in that credo. Don't anticipate, participate.
Exactly.
Correct?
Sure.
Yeah. Final question from me.
So much easier.
Is, you have been there, done that, absolutely successful. So what is left in your bucket list?
Well, right now I'm working on probably what I hope will be the crowning achievement in terms of books in recent history.
Fantastic.
It's going to be called The All-Weather Trader. It's a story about sort of what I learned along the way in my life. It gets into all of the different things that I'm doing right now that allowed me for the last several years to waltz through all this nonsense in the markets and come out smiling. I think it'll be well received. It's a very friendly writing style. Everybody will be able to understand it.
Sure. We look forward to that.
So that's one thing. The second thing I'm working on is I'm consulting with a gentleman in Michigan in the US of A on in the cloud trading platform and execution platform that I will probably be using here shortly to do some of my daily work. And it will actually pull in data. It will actually have a bunch of indicators that you can use, and you can specify your own parameters and time periods and make it suited to you. And you can simulate history. You can set different risk levels and position sizing levels. You can measure volatility and set your position sizes by volatility. You can manage your total portfolio volatility and risk levels. And it'll do everything for you, and then it'll ship your orders for you. And you can do it in the cloud. So you can start it with the phone. So this is going to be a very powerful platform. It'll be something that I'll use myself, and I will probably help do some webinars on how to use it intelligently. Because I think a lot of people do platforms and they don't really know what they're looking for. They're just, they run, 1,000 simulations, whichever the best one comes out, that's what I'm going to trade. That's not a good way to go about simulating history. So I'll give people a lot of knowledge, things that I've learned over the years on simulations and how to deal with aspects of that and what return to risk measurements I like and why I like them, and just a bunch of stuff like that. But I think that that's going to probably be starting to be put into practice this year. And I hope by early next year, it's commercialized and out available to people. So I'll have that project finished. So I'm working on that. And then beyond that, I'm really comfortable with what I'm doing in my trading. I don't have any super big projects going on there. Mostly like what I'm doing.
Travel.
This interview.
Travel. Travel and playing golf in different.
Travel. I like to stay home, but
okay.
But I have everything I need right here. It's hard for me to get on a plane and have the seat be so close to my knees. And but I do some traveling. My wife likes to travel. She was tied down all her life with real estate. So when she wants to go someplace, I'll tag along and carry the luggage. But I like trying new things. I make wine. Actually, I've got a batch that I've got a bottle that's all ready to go.
Okay.
Right over here.
Very interesting.
That comes out nice. And then we're going dancing in a couple of weeks at a black tie affair here locally that I signed up for yesterday. And so I have a lot of different things.
To do. Good to know.
Play golf, work out, go hiking.
So you do everything. You do everything to make yourself happy.
Yes. I really like to go out in my yard here, and I'm the Italian gardener. I have my own hand shears, and
good.
I've taken courses in pruning. And I know how to make the whole yard bloom beautifully. And our yard,
like your trading career. It bloomed over time. I'm sure your garden is also blooming and will bloom.
So I do things that I like to do. Last night we just watched a really wonderful movie that I enjoyed, and
what was that?
It was called A Cowgirl Song, and it was a musical that had a lot of country music in it, which I enjoyed.
So you love country music?
I like all sorts of music. I listen to jazz. I listen to classic rock sometimes from the 70s when I came out of university.
Queen, you like Queen?
Cream,
band, Queen.
Yeah, Cream, Eric Clapton. And then I even like some of the pop stuff. I actually listen to easy listening sometimes when I just want to focus. I'll turn on what's called chill, which is just repetitive, very monotone. It's almost puts you in a trance. And I can focus and either write my book or, there's no singing. It's all just instruments and sounds and electronics and
got it.
I like it.
No wonder you have so many strategies, because you're so wide and choice of music. So I know it fits well with your thinking, I suppose.
Yeah, if you want to go bold, you need to go to the classic rock.
Yeah, I know. Yes. Yeah, fantastic. So I have finished with mine. It's a pleasure to have interacted with you, Tom. And I'm hoping that I come one day and meet you and have your wine and look at your garden and watch you playing golf. I have not played golf, but let me at least watch you. And hopefully you'll score a hole in one.
Yes, I've had 7. I think I've had 7 in my life.
Oh, fantastic. Fantastic.
Great, Tom. It was lovely talking to you. It was altogether, it was complete very good session with you. So any last word to our new traders? Any last?
Well, I would say try to figure things out before you jump too fast. And I'd also say always start on the low risk side and work up the risk to the level that you need to be eventually. In other words, almost treat real money as if it's a test account and treat it like you're trying to keep risk extremely low, volatility extremely low. Just learn how to execute trades and follow your strategy. Don't see if you can actually test yourself with real money, even though it's small, and do exactly what you set out to do every day and learn what gets in the way and solve those problems before you ramp it up to bigger sizes and bigger risk levels and bigger volatility levels. That's probably the biggest thing I see people screwing up.
Yeah.
Great,
Yeah.
great,
Thank
great.
you. Thank you, Tom, once again. They've really been wonderful. It's been absolutely spectacular in that sense. We learned a lot, and I'm sure the viewers also will learn a lot. We hope to meet you again soon, both on the webinar as well as in person. Thank you once again. Namaskar.
It's been fun. Thanks, guys.
I hope you had
question.
fun. We had great fun. We had great fun.
And definitely, Tom, we will
More
be in
important
touch
than
in
that,
future.
we also
Definitely, we'll
learned.
do another session.
Yeah, it was fun doing this.
Yeah. Thank you. Thank you.
Okay, thank you, Tom.
All right.
Yeah.
Enjoy your life.
Thanks a lot. Yeah. Thank you.